In my experience, people don't really know how to define risk. They don't think about risk. If they do think about risk, they tend to think about it in terms of standard deviation, right? Like how volatile is that? So if I want more risk in my portfolio, I'm just going to get some more volatility.
There's a whole theory around, what we call like latent factors. So like things you can't really measure, but that's what drives really the economy, right? And so how you protect your wealth from those things.
And I say this tongue in cheek here, but like we've lived in this world where, hey, 15 years, every time the market dips, we buy it up, but it just goes higher. Like why does any of this matter anyways, right? Like, okay, so COVID was a tail event and look how much higher we are today. Or, to the tariff tantrum last year was a tail event and look how much higher we are today.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey everyone, welcome back to another episode of the Tall Oaks Podcast. I'm your host, Brandon Ducharme, and today I am joined by Dr. Ron Piccinini, who I was originally introduced to via his work around risk framework, his framework around risk and his studies on that. So originally I got introduced to Dr. Ron, I think I met you in 2023. Is when I first met you. So it's been a couple of years, and you gave this really interesting presentation at a conference about tail risk and the effects it has on portfolios, and I found it really interesting. And I found out you had a white paper, so I went and read the white paper, and I think it changed a lot of how I think about investments. So I thought, what a great opportunity to, have you join me. And I would love to explore the kind of the nature of your paper and your theory around tail risk here for investors, because a lot of people don't know. In my experience, Ron, people don't really know how to define risk. They don't think about risk. If they do think about risk, they tend to think about it in terms of standard deviation, right? Like how volatile is that? So if I want more risk in my portfolio, I'm just going to get some more volatility. And, that's not how I think about risk. Is there a way that you like to define risk?
Yeah. Well, first of all, thanks for having me. It's overdue and sounds like hopefully we're going to have fun here. My definition of risk is very simple, and it's came over 20 years of doing this. But for me, I would just say, look, if you were going to what's the risk of the S&P 500? Right, to make it a quick example. Well, I would say, if you were to ask me for a loan to hold, let's say, $100,000 worth of S&P 500 for a day, how much equity would I require you to put down, right? Because I'm going to say, if the S&P crashes 10%, if that's my risk, then I'm going to ask you to put 10% down, right? And if I'm too conservative, well, probably another broker would come in and say, no, come deal with me, and I only require 7%, right? So, but if I only require 1%, well, I'm going to go bankrupt. I'm going to start losing money. So I think if you start thinking about the amount of collateral that's needed to support a portfolio or the loan on a portfolio or a series of assets, then we can start having intelligent, real world conversations instead of having mathematical definitions. And then, once you're trying to identify what the beast is that you're trying to model, then you can bring math and stats and computers into it to help you facilitate the management of the risk, right, so to speak. But at the end of the day, it's something bad happening to you from the P&L point of view times some sort of probability, and then that's your risk. So I'll stop with that, but that's how I think about risk. Is like, how bad can it go, and then what amount of capital would I require if I had to make a loan against that portfolio, against that position?
Maybe this gets too deep in the weeds right away, but is there a point there where you get so far out on the tails that you say, okay, well, that's a risk I'm willing to absorb it as an investor. So if, like using your S&P example, if you said, hey, I basically think within, and I'm making this up just as an example, within, 7 standard deviations, S&P goes down 10% in one day. So if I've got, 10% down in almost all circumstances, I will be fine. However, there is the potential still for Black Monday, right? From 1987, right? Like a 20 or 30% down in one day.
Yeah.
Right. Yeah. Like it could happen. I mean, insanely unlikely, but it could happen. So is there a break even point sort of in your framework that you think about risk of like, okay, well, so the risk is anything could go to zero or way worse than we would ever think, but how far like would it go in even a insanely bad situation? And beyond that, I still have to take some kind of risk as an investor.
You name it. It's sane versus insane. I mean, look. So first of all, yes, you have to take risks to make money above the risk-free rate, right? So in that example, yeah, I'm supposedly making a loan, so I'm going to have some sort of return. I just don't want to go BK more than X% of the time, right? And that risk tolerance, that's kind of how I live my life, right? So the only way to be sure that you have no risk is obviously to have like a limit that's so huge that it'll never get reached, right? And so think about it. We can argue whether it's like 7%, 10%, 8%, on the S&P all day long. But like, let's say you short the S&P. Are you really worried about the S&P getting multiplied by 5 overnight? Not really, right? You're not worried about the S&P going down to 0 overnight. So somewhere between, and we know, market returns are not normally distributed. So, there's more to life than 3 or 4 standard deviations, as you just mentioned. So somewhere between 4 standard deviations and the S&P going to 0, there is a decent limit that we can live with, which is prudent. And, that's up to you to live with it. So I think that's the difference between risk estimation and risk algorithms, and then how you manage the risk, which should be informed by your estimation, but that's not necessarily how you manage it, right? That's if you can't absolutely be in a situation where like let's say you're completely screwed if the S&P drops more than 10%, well, hedge that, right? That's the risk management part of it. But if I'm just trying to think in terms of probability, I'm going to say what is a reasonable, not extreme, reasonable scenario, very bad case scenario, but reasonable, right? So S&P going down to 0, for me, that's not reasonable because somebody will buy it, way before that. S&P down 20%. Yeah, it happened once, once every 80, 90 years, and once every 100 years, you'll see something like that statistically. Okay, we already had one, right? So are we good for a while? 10%, that could happen a lot more often, right? So we gotta put a reasonable check, I think, to the scenario we're trying to analyze. I don't think there's any. I mean, if you're getting too conservative, you start leaving a lot of money on the table, because your risk estimates are unrealistic, right? Does that make sense?
Yeah. Well, I'm curious what led you to exploring tail risk and how that drives portfolio performance.
Yeah, we can go. This is an interesting story. How far do we go back? All right. Well, back in France, when I was a young equity trader, I discovered the wonderful world of technical analysis. I said, "Oh, this is simple. Let's go trade." And then, long story short, of course, I made money at the beginning because I caught a big bull market, went very leveraged, and then one day, a big one of the largest hedge fund in the world at the time, called LTCM, blew up, and I was caught on the wrong side of that trade. I blew up as well. And then I was like, man, if I could have just have held on to those positions for like a week, I would have made like 300 grand. So, even though I had no idea what I was doing at the time, I reached what we call ergodic stake, which means like, you get killed because, position move against you a little too much. And so, yeah, that was a painful time, but eventually I say, look, I gotta, if I'm really good at investing, I gotta really, really develop a set of models to understand how much a portfolio can lose, right? And then never be in a situation where if you have like a huge event against you there, you're dead, because then you can't let the law of large number kick in. So that was number one. And number two was like, well, the guys who blew up, those guys were not bozos, right? I mean, they're like Nobel Prize in financial economics. They're like the best, bond traders in the world, all that good stuff. So kind of led me to believe that there was more to the story. And there was like something to discover there. So yeah, I went on the deep end there. I read every book in the library, literally. And then I did my dissertation on what is now known as black swans or heavy tails, which are two different things. But and then 20 plus year career trying to help people understand the risk in their portfolios and how to manage it. And there you go. So
Yeah.
started with early, and then yeah.
Help our listeners understand like what is what is a black swan, and then what's heavy tails mean?
Okay. So black swan comes from the book, Black Swan. And so the metaphor is basically saying, if you're a European scientist, all the swans are white, right? And so you have this knowledge you have a model that says, if you're a swan, you're white. And then, somebody discovers Australia and they run into black swans. So the question is, okay, you have one more observation. Here's a black swan, and that invalidates your model, your understanding, which could be built on thousands of years of data. It only takes one observation to really change your understanding of the model. That's the black swan story, right? And so in finance, Taleb coined this, this term. It says like sometimes you just get one observation that completely invalidates, statistical understanding of the sample, right? And so that's a process. Now, colloquially, it just means something moved a lot, and the reason why this is confused by the general public, it typically is because the standard risk models that we've been using and that the industry still uses cannot put a decent probability on something that's like far away from the mean, right? So, I'll stop with that. But black swan just means we have one observation that completely changes your understanding of the world, right? And so think about it. Remember during COVID, you had like oil prices going negative in Oklahoma somewhere, right? Like, I didn't know that was possible.
Yeah.
So we had one observation that completely changed my understanding of what oil prices can do. So that's it. Now, fat tails is a little different, right? Fat tails just means, it's a very technical term. For decades, and we can go into the why. Financial quants, professors, whatever, they say, look, why don't we model stock prices or asset returns as a normal distribution, right, as a bell curve? And so they got the idea from the physics world, and they say, well, most things in nature follow a normal distribution. And normal distribution is the stuff you see everywhere. You get 68% within one standard deviation, 95% is two standard deviations, 1.97, and then 99.5% is within three standard deviations, right? Because that's something you see in nature all the time. So they thought it was a good idea to steal from physics and biology and apply it to finance to start thinking about how asset prices move. And unfortunately, I don't know about unfortunately, but in reality, asset prices have like movements that are way more severe than a normal distribution would describe, right? So you'll see 20 standard deviation moves like 6-7 times a day. I mean, I think if you just put up your favorite quotes program, you'll see, things that move 70% in a day. Like you have like, 8, 10 a day of those things moving every day, either down or up. So those things are tough to explain with a normal distribution. And so the term fat tail, or heavy tail more politely, comes from the use of probability distributions that assign much bigger probabilities to tail events. So they're fatter in terms of probability in the tail being what's away from the mean, right? So hopefully that
Yes.
that makes sense. But under a normal distribution, right, you'll never see anything past 4 standard deviations. It's absolutely, it's almost impossible. Like the joke is like so not to close the loop, if your model if your concept of the financial world is there's nothing past 4 standard deviation, right? And you have like something that, let's say, move 10, for instance, then you look at the 10 and say, oh man, that was like impossible according to my model, not according to reality, according to my model. Therefore, that was a black swan. Therefore, I'm off the hook because this is something that nobody could have predicted. And the problem there is like, now, if you actually had like decent modern risk models that was still in the probability realm, right? And you just didn't manage it properly. So there are things such as true black swans, but a lot of the stuff that we call black swans, like for instance, the great financial crisis and all that stuff, it's not at all a black swan. It's just, your risk models suck, dude. And you didn't have enough probability in the tail to account for the true risk of the system. So,
yeah, that makes sense. I often hear people say, well, no one can predict a black swan, and it's always
Correct.
black swans that bring down markets. So you never know when it is. You can't time it. Nothing you can do as an investor, except
Correct.
for, I don't know, pray and hope and stay.
Correct. So
stay
if it's a
invested.
true black swan, you're absolutely correct. And that gets you off the hook, right? There's nothing you could do, it come out of like nowhere, blah, blah, blah. But I'm telling you, a lot of what is called black swans are actually well within, probability theory. Like, if you say, what's the 3 standard deviation event in the S&P 500? It's probably like down 2.5%, 3% on a one day, right? So we know that stuff, like 4, 5%, 10, 7% days happen all the time. So if your model says, well, it was impossible, we couldn't predict it, it's like, no, you could. You just have a shitty model. Does that make sense? So
yeah.
Part of it is, yes, there are true black swans, but they're extremely rare. I think like the last black swan we really had was probably the flash crash. That's something that nothing prepares you for that. I mean, you think about it, but that's about it. COVID, that wasn't a black swan. It was just like a tail event, but it's well within the normal probabilities. I shouldn't say normal. The reasoned probabilities for stock market volatility. So.
Yeah, I mean, like we were talking before we started filming about that meme where there's like the like the caveman on one side, the Neanderthal, and the Jedi on the other, right? And I'm oftentimes the Neanderthal guy as a market technician, right? And so I look at a lot of stuff that people have called black swans, and I say like, well, like I don't know why, but I know that it's showing up in price. And so the stuff that is important, the hive mind in mass, is typically it's showing up in price somewhere, right? It's showing up in some kind of intermarket action, and it can lend a lot of those early warning indications, right? So where people come out and they say like, well, you can't, no one could have predicted COVID. It's like, well, hold on, like price was already weakening. There was a lot of intermarket dynamics happening. It's just on the surface of the S&P, it kind of was still going up in January, but people knew what it was long before the market crashed, and and there was people talking about it, right? So it was predictable in the sense that like if people predicted it, obviously it's predictable,
Correct. 100%.
Same with the GFC. No one could predict the GFC. Well, like if there's people that got short the market, then people could predict it, right? Now you can say it's difficult. You can say most people don't look for it, but obviously it's there. what's interesting is we tie all this back to, you're just saying like there's a framework to risk model this. I'm saying like it shows up in price in my framework of how I trade and do a lot of the work that I do. But there's a way to observe that this stuff does happen in markets. Why does it matter though? I mean, Ron, we've lived in this, and I say this tongue in cheek here, but like we've lived in this world where, hey, 15 years, every time the market dips, we buy it up, but it just goes higher, like why does any of this matter anyways? Right? Like what, okay. So COVID was a tail event and look how much higher we are today, or, to the tariff tantrum last year was a tail event and look how much higher we are today. Or 2008 was a black, air quotes here, black swan, and look how much higher we are today, right? It's just the solution, those tails don't matter, Ron. You got to just stay invested longer, right?
100%. I mean, it matters because people flip out, right? Like fear and greed. So, they see their retirement account, going down half, and they're not going to have a sense of humor about that. Most people start having very sensitive fears around a 15% drawdown, right? So it's all about the tolerance for volatility, which is, in the advisor space in general, but wealth management, it's all about that now. If you're an institution, right, you don't care about the next 300 years, you're risk neutral. Good for you, right? Like that, you have a different problem. But for the average guy out there who may have like 15, 20 years and they get, they got to manage the money a certain way. Unfortunately, they can't completely ignore the volatility, right? I always tell people, well, if you believe things always go up, then you should be up. You should be only invested in triple levered 5x whatever QQQ, right?
Yeah.
And you're not. So because like QQQ can drop 55%, and if you 2x lever that, you're down to zero. So there is a non-stupid number out there, right? It's tough to pinpoint it, but there's a neighborhood at which, like, you start playing with fire, and sometimes analytics can help you, right? But that's what it is. I mean, a lot of people never made it back from 2008. It's same, or it took them 20 years to get back on their feet. So those things matter, right?
I think if I had to sum up what you're saying, right, or maybe
sequence of returns risk, right?
Well, it's about behavioral finance, right? Hey, if you zoom out, those the 08, the losses in the .com and the 08 and the on a inflation adjusted basis, that's 17 years of no real returns, right? It goes away. It's a blip. It's a tiny, you got to squint to see it almost. But in reality, like people are still people during that 17 years, and they still have to live a life, and they still might need access to their capital and all of this. And so, if your time horizon is truly 100 years and you have no liabilities in between at all, then it does go over, you can just capture market risk premia over time and stay invested. I think for me, one of the things that I sort of learned is not only do people have what you're saying is absolutely true, right? Like people get really sensitive about drawdowns, and there's two problems that come from that. Is A, if they don't talk about that ahead of time, or an advisor's not helping them manage around that, what happens is they puke at the bottom and they never get reinvested, right? They never come back to the table, and that's a disaster, right? And so, we've heard stories about people that, got smoked in 2000, by the time 08 came around, they thought they're a genius. They're still not invested until 2019. They get invested in 2019 and they get invested just in time for COVID. And then they puke at the bottom again and swear the markets are rigged, and no, they've gone up over time, but they're doing it all wrong because they're set up for failure, right? Because it's not, and this is the part that I think a lot of financial advisors miss on. is they have this idea that S&P can't go to zero, right? Like we talked about that earlier. Like no one's really worried that the S&P goes to zero. But in reality, when you start talking and you get off the, academic paper framework, or you start realizing that, hey, that squiggle on the screen is actually, somebody having to think about their life savings and their liabilities in their lives is, hey, it's gone down 15%. And I might be losing my job because of this incoming recession. And I've got a mortgage I have to pay. And that's the pile of money how I'm going to pay it. And so, although it's rational to say, hey, the S&P or whatever you're invested in is probably not going to zero. And if you wait long enough, it'll probably recover. They're going, all of a sudden, I don't know if I have the time to let it recover, right? I might need those funds, right? It's still my capital to be used in my life to pay my liabilities that come up. And whether that liability is making the mortgage payment or the car payment or putting food on the table for kids or paying our health insurance or whatever, right? Like things have to get paid. And that's what those funds are for, right? And so
100%. Yeah.
you have to appreciate that there's that connection there. And most people don't. They just try to do the easy thing and say, well, you just got to wait longer,
Couldn't agree more. Actually, I wrote like a tiny paper, but it's kind of about that, right? It's like risk management really is about, not being sensitive to one type of risk, right?
Mm-hmm.
And so I remember in 2008, 2007, I was, a young, working a bank. And I had a guy working with me, and the guy was certainly not an idiot. He had like a really high IQ, had his stuff together, whatever. But I remember he had like some money on the side. I said, Ron, my financial advisor is telling me buy the S&P 500. And I'm like, bro, 95% of your wealth is your home equity. The fuck you doing, buying the S&P 500? He looks at me like I have like three heads. Like your biggest risk is interest rates go up, and that affects the price of your house. Like that's 95% of your wealth. So, and then same thing, right? Now banking crisis comes up, loses job, home value go down. S&P is not hedging anything, right? S&P is down 50%, and so you basically, all the coins are coming up, heads, and you have no diversification, right? So how you manage the risk, instead of trying to say, well, this is how bad things can go, you should say, well, am I getting ever in a situation where it's really bad for me? I'm not gonna, make it alive. So again, if you're a financial advisor, you know way better than me, but if you start telling people you should buy like derivatives on interest rates, they'll probably look at you like you have a three head too, right? Like say, no, I want to go buy like the S&P 500 and wait. So yeah, like there's a whole theory around, what we call like latent factors. So like things you can't really measure, but that's what drives really the economy, right? And so how you protect that from how you protect your wealth from those things, right? Like 2022 is a really good example where, oh, well, you get bonds, you get stocks, you get gold, you get Bitcoin, cool. They all went down at the same time. I mean, gold was flat in 2022, but one moment was down 7 months in a row in an inflationary environment, right? So your diversification, at least the academic definition of diversification, didn't mean squat, right? Because the underlying factor was the central banks around the world acting as one factor, right? And so if you were exposed to that, there's no way to run. So I'll stop with that, but hopefully, it gets us like into thinking a little bit. It's like what risks are you really having? Even and that doesn't show up in the data. You get to do the analysis.
Yeah. What I think in your white paper you had a study that you did that looked at tail events and it drove a certain amount of kind of portfolio returns over time. Like, hey, when markets are, low volatility, it's nice to be invested, but it's not having an outsized impact on your total performance, either good or bad per se, right? Can you help refresh me on what you're finding?
Yeah, for sure. I mean, I think like, another thing of fat tails or heavy tails discussion, one of the consequences of that is most of your results are going to be driven by a tiny amount of effort, right? Same. So in case of markets, like let's say I'm going to give you rough numbers because they change every day, but suppose you invested $1,000 in the S&P 500 and you buy and hold till, I don't know, end of 2024, right? If you miss the best 0.5% of days, which is not that many, right? I think your $1,000 becomes like $1,200 or $1,400, right? It doesn't even meet the risk-free rate. So most of your returns, if you just buy and hold, your $1,000 becomes like whatever, almost $8,000. So yeah, you multiply your money by 8. Good for you. If you miss the best 0.5% of days, so the right tail, you don't even beat the risk-free rate, right? So that's why advisors say when you get to stay in the market, etc. The coin flip is like if you were able to avoid the worst 0.5% of days, your $1,000 becomes like $34,000, right? So avoiding the worst days is way better than missing the top days. But at the end of the day, your entire investing career or that 20-year period depends on two things. It depends on where you were when you had the tail event. The inside 99% basically doesn't matter. And it was like, well, day in, day out, 20 bips here, 30 bips there. It doesn't matter. At the end of the day, it's like, where were you when the big days happen?
Mm-hmm.
And I wish I knew, when those things happen. I'd be if somebody knows how to do that, call me first, and I'll make you extremely rich.
Yeah.
I don't know how to do it, but there's you can use statistics to help you. Well, this is a regime where a lot of bad stuff might happen. Others were like, oh, it seems like a green light, so let's not pussyfoot around. Let's be invested.
Yeah.
And yeah, I mean, but that's the statistics, right? Like same thing. Like I think of all the tens of thousands of companies, in the history of the New York Stock Exchange, I think only, I think like 60 companies generated like half of the revenue. I mean, it's just like tiny portion just generated like outsized return versus the rest of it, right? So that's what you see in finance all the time. Every time you get free economic interaction, the top 1%, the top 0.5%, and the bottom. This is not where you would see in physics. It's like,
yeah, it's not
it's
normally
got
distributed.
a really outsized influence on the sample. Yeah, sorry.
Yeah, I think you're reminding everyone why it's actually really tough to just pick the good stocks. Just own the good ones and then just hold on to that good stock for a really long time. And the reality is it's nearly impossible, right? And even if you pick a winner, the longer you hold on to it, the more you increase your odds that it turns around into a loser over time, right? Eventually something happens. But
yeah,
one of the things.
Sorry to interrupt, but when I hear that, I say, "Okay, boomer," right? Because
yeah,
back in the days, you were a fund manager. You could actually talk to people, and get privileged info, like info that didn't give to everybody, right? Like from $10 billion guy, I go talk to your little company. It's likely going to give me like some really good info, and then the law changed and say absolutely freaking not. So the only way you're gonna outperform right now over the long run by picking stocks is if you have an informational advantage. And so if you do have one, either you're in Congress and you can do it, or you're not in Congress and you're going to end up in jail. So even if you had that advantage somehow, you're not going to be able to profit from it long term. I mean, so
yeah,
the only guys who can do it is Congress, because you get an information advantage. And so if you don't have an information advantage, you just get lucky. And that's the problem with finance in general. It's like stuff that doesn't works 50% of the time roughly, because otherwise you could do just the opposite and make money. So that's another mind screw for the people who work in this industry. Is like, it doesn't work. It means it works 50% of the time roughly. And so you always can find an example, say, well, if this, then look at this guy. It's like,
yeah.
I see people win poker hands with 7-2 offsuit. That doesn't mean it's a good strategy. So I'll stop with that, but impossible.
the other thing, what you were describing a minute ago, reminded me of when we're talking about missing kind of the worst days of the best days, right? It's another white paper I read recently by some gentleman. Basically, those days cluster together, right? Their findings were, hey, your best days are like right next to your worst days, and so their whole theory was you just miss both of them, right? Like you just miss both of them, and even if you don't outsize your return to the upside in a significant capacity, you limit your risk in a significant way, right? And you limit your behavioral tendencies to puke at the bottom and then miss the best day, right? Like, it's not a perfect system, but if you have a system to do something like that, then they felt it could be beneficial, right? What is, does your paper or framework allude to anything around that? I mean, is it worth it to try to, identify opportunity sets or statistical advantages in the market where it's more likely or, more favorable or less favorable to be invested? Or does your framework say like, just have less risk, right? Like if you can't handle a 50% drawdown, then you shouldn't be in a portfolio of S&P. You should be, if you can do a 10% drawdown, you should have no more than maybe 20% of your money invested in, S&P. So that way it gives you kind of across your portfolio the correct drawdown, right? Is there an advantage to doing one over the other?
A lot of really good questions. I would say yes. Like you should probably have a really, really good idea of, how big of a drawdown you can stomach, right? And I know it's tough, especially for guys, because they'll overstate it by like 3x, right? The number of friends I have who told me they could take a 50% and then start calling when it's down 15. Yeah, pretty much all of them, right?
Yeah.
So people who lie to you, right? And it's not, they're lying to themselves too, right? But it's just a different part of the brain that's engaged when they have those questions. And then when the emotion kicks in, it's all different ball of wax. Same thing, I'm typically a chill guy, but I have tossed my 7-iron in rage on a golf course a few times. And then, you lose rationality for a few minutes. Then you try to remember where you are. You're trying to be here for a good time. But like in that moment, we're not really rational. So that brings me to point number 2, which is, I'm sure there's like dozens of systems. I don't claim that I have any special gifts in that regard, but having a system itself is actually really, really important because it acts as a guardian against making decisions under duress, under stress, when your brain is reacting to emotion instead of like reacting to stats. So having a game plan, no matter what, is invaluable, right? Now, it's better if the system you have has some sort of grounding in reality, right? It's not just well, astrology or whatever, or flipping coins. Like, if you have actually something, then you should exploit that. So there's the old theory around overfitting, around it's funny if like 2 moving averages are moving, well, the 13-day and the 30-day, but if you do the 12-day and the 30-day, it doesn't work anymore. You're probably overfitting, those types of things. So, I think wherever you have like information, you should use it, but you should make sure that the system is not too smart that it becomes fragile, right? Like a good example I've been using is, if you're investing, for the long run, if you have a $10,000 trading account that you want to gamble with, like that's all different ball of wax, right? But if you have your wealth and you want to stay wealthy over long periods of time, you want a Land Rover, you don't want a train, right? Like let's say a high-speed train may be the most efficient thing as long as there's rails, right? But when the rails end, it's completely useless. So a Range Rover, will be all-terrain. Whatever 4x4 you want it. I'm not, but you want something that's like robust to changing terrains. Otherwise, you have a system that is optimized for a certain set of conditions, and if and when those conditions disappear, you get something that's absolutely useless and can wreck you. So that's how I kind of think about systems in general. And so, me personally, We do have one that's based on implied volatility, and we're trying to say, look, this is like a zone where normal volatility, you may have like ups and down, but markets function as normal. There's another one where it's orange, which doesn't mean it's bearish, by the way. It just means like very small money is worried about stuff, and then red, which is like, okay, we're in uncharted territory. We should probably not be betting here. Should probably be in something defensive and wait for the storm to pass before we re-engage, right? But that's as sophisticated as I'm comfortable doing, especially at the asset class level, right? Again, it's different trading 10 grand and trading 10 billion. So you want your system to reflect, how much capital you need to you're managing. So does that make sense?
Yeah, it makes. I mean, to me, it does, right?
I mean, I think it does too, but yeah.
Well, I highlight this a lot of times to people because the argument, I'll hear from people is like, hey, look, active management, they underperform the benchmarks. And there's validity to this conversation. It goes back to what we were talking about picking stocks, but really what they're typically doing is you say, okay, well, what based on what data sets, right? Well, based on Morningstar data. Okay, well, that's basically you're looking at, large actively managed mutual funds, right? I kind of toss out the old example of, like the old Dodge and Cox actively managing. There's a team of people at these firms that are trying to pick stocks on a fundamental level and outperform the market. And as you identified, it's a nearly impossible game. And if they do tend to outperform, it's usually not sustainable. And even if they do sustain it, it's very minor anyways. And so most active managers actually do a decent job of outperforming in a minor way. But then once you pull out the extra fee on the fund, all of a sudden it underperforms anyways. And so there's this whole thing. Well, just buy the index. Don't, people can't beat the market. You can't beat the market. And, I just disagree. And the reason I say this is because I've just spent enough time around, hedge fund guys and, institutional managers and people that have worked on desks at these large firms that say like, oh no, it's totally can be done. We're just too big. It's like, hey, if we're managing a mutual fund with $100 billion, like you can't, to try to get $100 billion with the current market, inelasticity, like I think $100 billion out of the market is going to take something like $1.3 trillion of market cap out. It's like
easy. Yeah.
That's like, it's like massive, right? So you can't just be like, oh, hey, conditions are unfavorable here. We're out. And so the reality is like, who can do that? And, who has the ability to potentially, move and be nimble. And it's, smaller shops, right? And the reality is smaller shops don't run big, massive mutual funds that publicly publish their data to everyone every day. And so the whole thesis around how people are perceiving their investments to be managed is based upon a flawed data set, in my opinion, oftentimes, right? It's part of the system. It's part of the framework, right? And people are looking for truth. And that's always admirable, but I think they're working with flawed data a lot of times, right? Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you.
I agree with what you say, right? I would add this is like, who cares? I mean, it's true, like, 96% can beat their benchmark.
Sure.
But if you're an individual investor, again, are you trying to beat the benchmark? No, you're trying to retire. You're trying to stay rich, right? Like you don't you don't go to an financial advisor and say, hey, I'm poor. Can you make me rich? That you have to figure out on your own, right? Like you got to take risks, you got to marry well, whatever the case, which would be even a bigger risk. Like it doesn't matter, right? Like now you got a bunch of money, and the question is, I want to stay rich, and there's a level below which I never want to go. So that's the benchmark you're trying to beat. It's that one, right? So when people compare this to an institutional setup where say, well, I don't know, we're Harvard there, we're trying to be here, in the next 300 years. Yeah, okay, well, you can take underperformance of international stocks for the next 50 because, who knows in 50 years if the US is the dominant force. Who cares? Like, that's got zero relevance in Joe Blow's retirement account, who's trying not to overspend his money. Like, so all those things, like, if you're not, now, having said that, there's plenty of people who think they can, delusion themselves to think they can pick stocks and this and that. So, that also skews the stats on the negative side in terms of active management. But if you're not actively managed, I don't see how you make it, right? Like, it's way more complicated than getting a 60-40. You're either leaving a ton of money on the table by doing this, or or I mean, like, yeah, I'm trying to not get into the rabbit hole there, but this is like one of the stupidest thing from an empirical point of view that's been believed by the masses over the last 20 years. It's just mind-boggling, right? Like, so I'll stop with that. But again, like, nobody's there. I don't wake up in the morning and say I got to beat the S&P 500. Nobody is waking up and it's like, look, we have a tool and we want to make sure that the portfolio we put together has the statistical properties that the user needs, right? So, hey, I need something that's got a lower downside capture than whatever equity markets. So I need something that has a higher batting average. I want something that has the max probability of beating a certain rate of return. Like, those are real world portfolios. Like,
Yeah.
nobody's there trying to wake up like, I really need to beat the S&P. Like, that's.
Yeah, well,
like, hedge funds might do that, but even the hedge funds are like, no, like, if you need to beat the S&P, just go buy cheap beta for 5 bips. Right? What I'm trying to do is like provide something that's uncorrelated, right, or has like a different distributional capabilities. But you can't have that discussion with.
Well, my general thought is. My general thought is, like, if S&P just goes up over time and you're that convicted to it, and you really can sustain a massive drawdown, but the drawdown you're saying is completely irrelevant regardless of size because you feel so confident that 10 or 15 or 20 years later, or whatever, it will be higher.
Yeah,
man.
Great.
But you know what? It's really easy to get leverage on that and leverage up. Use 1.5 times leverage all the time, and in theory, right? Like, that would play out better. Now you run the risk of having an absolutely catastrophic drawdown to your personal financial life. But if you're that convicted, and I think what I'm highlighting is, like, intuitively, people, when you explain that, they start to realize, like, no, that really sounds imprudent, but they just don't internalize, especially investors that haven't invested through, .com and 08. And so it's funny is you rarely are you going to ever have these kind of conversations with somebody that invested during .com and 08. It's just
right.
They get it. But people that haven't, right, they don't think the S&P could go down 50% and just, and then, by the way, right as it recovers, it goes down 50% again, because they just look at it and say, black swan, not going to happen again. Those were the black swans, so, now we can just buy and it just goes up and should be fine over time. And the reality is, like, man, I have found that when you put drawdowns into dollar terms for them, the conversation changes completely, right? So if you say, like, if I'm talking to somebody and I say, hey, like, what kind of drawdown starts to make you really nervous? And they say, I don't really know. And I say, like, what about 20%, 25%? Yeah, that might make me a little nervous. Yeah, that could make me nervous, And I go, okay. Hey, so your account is like $1 million today. If I called you next week and your account was was down $150,000, you're at $850,000. What are you thinking? And they go, ooh, that would really burn. I go, that's only 15%. What do you like? You're upset at 15, thinking that's unrealistic results. But it's like, it just seems easy when we talk in just percentages. You put it in dollars where most people's heads are at, right? In terms of viewing their account and balances. And and they just go, wow, that would be, yeah, that, you know, and I hear people that say like, oh, that's, you know, man, that's 7 years of my first salary out of college or something, right? And you go like, yeah, that's how you're thinking. You're not thinking about, hey, it's down 10, we need 11 to make it back. And, you know, that happens once a year on average. So no big deal, right? They think behaviorally, we're not wired to think like investors, you know, we're wired to think like savers.
Completely agree. And that's why, I mean, I think like, you know, that's why me personally, I don't trust myself making discretionary decisions with money because I know my instincts are 100% wrong wired, right? I'll double up in the wrong spots, you know, I'll doubt, I'll do this and that. So for me, having a quantitative discipline, quantitative model that I stress test 100 ways from Sunday, but then, you know, I rely on that and I'll never override the computer, right? I'll change it later if new evidence is created. But that's exactly for those types of situations. It's because you're not going to think, yeah, your brain is not wired for finance. Let's put it this way. Like this is the most unnatural profession where your instincts will absolutely will get you killed. You know, like instincts that make you successful anywhere else will absolutely will get you killed in finance. So yeah. And then I think you're right. You know, I mean, as an advisor, like understanding the usual flaws. You know, I had like I had an experience like this back in the days. I had like a little software company where you know trying to do risk, and so we talked to this lady. She's very successful, and she's like, "Oh well, you know, love to know my risk." So we analyze her statement and say, "Oh, you know, you could lose 8%." And she said, "Oh my God, are you serious? Like, no way." You know, I told you know, my husband's advisor, I want like something medium risk, blah, blah, blah. And she thought she could lose 8% a year. And I said, no, you could lose 8% a day. And she said, what? You know, so when you put dollars amount and time frames instead of being vague about, you know, red, yellow, green, yeah, people have a completely different reaction, even though the numbers mean the same thing. Right?
Mm-hmm. Yeah. Well, personal finance becomes really personal all of a sudden when it's the dollars in your pocket, you know? One of the things that I've noticed people do in building portfolios is they just look at this historical framework. Most people are doing just some form of a back test of a portfolio, right? And just saying, hey, over a long time, stocks do okay, bonds do okay. You know, they kind of come up to the 60-40 conclusion. I'm not even going to get in the rabbit hole of like the complete disregard for, you know, like alternatives, but the idea in the passive world is like, man, so I've always scratched my head at this, like you sat on a portfolio then when the 10-year treasury was at 0.5% a year and inflation, you know, like inflation's prints are coming in hot. Like that's, like it's just intuitive, right? Like, so bonds are easier. Everyone kind of admits that, but like,
sorry, I don't want to interrupt you, but like all the big banks were long massive amount of 10-year treasuries.
Yeah, but like
sitting at 50 bips and they almost went out. Sorry, keep going.
Well, like, but I just like laugh at it because I'm like, you know, if you just look at stuff every once in a while, you can just like, hold on, this doesn't like make sense even. But the problem is people are so rigid in their framework, right? Because we're used to these long historical, hey, typically when stocks go down, bonds typically go up, right? And the problem is like correlations change over time. Correlations aren't stable. And so, you know, then you get these really uncomfortable periods. Like people that were the 60-40 investor in 2022 got absolutely smoked. And they still haven't recovered, right? And we're in 2026 now, right? They still are underwater on those bond positions if they still own them, right? And like most of them, I'll say, I guess I don't know every single one, but in general. And the idea is like you just didn't pay attention to the correlations because the correlations change. So has your framework noticed anything where correlations changing can cause a rift in portfolios or start driving tail events or be more present in, you know, kind of some of these fat tail events that happen more frequently than we give them credit for?
Excellent question. Yeah. So again, I think not to get the quant hat boring stuff, but correlation is a statistical concept, right? And it's trying to tell you on average, it's a measure of average co-movement between two things, right? So problem is average. Yeah, because yeah, typically when the S&P is up or down 1%, this stuff is up or down 0.8%. Well, it's on average, right? But as you said, what happened when the S&P is down 25%, right? So co-movement, which is the natural phenomenon we're trying to, or natural, it's the financial phenomenon we're trying to get our head around, has been measured by correlation by people who had like very weak computers, right? Or almost no computers, back in the 50s. So you can't fault them. They made an assumption because they were limited in the computation that they had. But in 2026, man, we have high-speed computers. We have like cloud computing, we have GPUs, you get all sorts of ways. So I think people are still making assumptions using correlations. I'm going to try to stay polite, but it's time to upgrade your quant game, because that's cool in 2003, but in 2026 correlations, I mean, come on, like this is like so outdated, it's nasty, right? So let's leave it at that. Now the next question is co-movement, right? Whether you measure it with correlation or like something a lot more advanced. So this is where you need to start thinking about the portfolio in terms of what's really driving it. What are the true factors driving your portfolio downside? The upside is you shouldn't worry about that too much, because billions of people are working hard to make the upside happen. And so like right now, I mean, we can have a discussion, but my analysis is just central banks. So central banks decide, yeah, we're going to keep printing, things are going to go up. But, if they change the story, then you have a negative co-movement across, and then they might decide to do this for XYZ reason. So, yeah, I mean, we can talk into my philosophy right now of risk management, which is don't even rely on diversification to do stuff. Use options, so exactly going into the trade or the investment. This is how much downside I'm willing to take, and now it's an accounting physical hard limit. But yeah, I mean, I think like if you're relying on diversification, it may have worked the last 20 plus years, but central banks are so big relative to the market, and if they act in unison, nobody's got a chance. Like they'll do whatever they want, and I'm not good enough to guess what they're going to do, right? So if I'm managing the risk instead of just estimating it, I'm going to be trying to be in a situation where I say, look, I need to know how bad this stuff can move, and making sure that this is robust to all sorts of outside events. But that's for a different story. So hopefully that made sense.
I think like if I'm understanding what you're saying, it's that if the risk management in your portfolio solely relies on historical correlations, then that's probably going to let you down at a very unfavorable time.
Yeah, but I mean, that is correct. But yeah, good.
I was just gonna say, if it lets you down, right? Like, it's like everything in finance is fine until it isn't, and so you can build a good portfolio using historical correlations, and it might be fine for a year, a couple of years, whatever. And then all of a sudden, you get the 1 year where you go, whoa, that was not supposed to happen. And it does happen. Right. And I think tying it back to the original conversation, like that's where a lot of people say, well, that must've been a black swan. And your framework says, no, we could have probably seen that coming a little bit more. You just completely, you did the ostrich, head in the sand thing and said, I'm going to pretend there's nothing here. Right. I think nowadays we just call them orange swans, right? We keep getting the orange swans in the market.
Yeah. But, well, I mean, look at the last month, right? Like what gold did and what stocks did, and what, like gold didn't pick up the slack at all, right? Where was the diversification last month?
Well, people forget like diversification is different than an inverse correlation, right? So like stocks and gold aren't correlated, but that doesn't mean that they can't like there's a difference between not correlated and inversely correlated, to say that like if they're not correlated, they can move in the same direction. That's okay and normal. They can move in opposite directions, right? But what you can't bank on, you can't place too heavy of a bet on, hey, one is going to go down while the other goes up, right? Like that's inverse correlation. And
yeah, but I mean, look, if everything is independent of each other, right? That's your best case scenario, right? Because now, you're reducing the volatility of your portfolio, but you keep the expected return the same. So but what is truly independent nowadays, right?
Well, yeah, because what you saw, like in theory last month, and I don't know this for sure, but I mean, you see a geopolitical event that causes routes in the stock market, but that same geopolitical event, causes routes amongst, foreign central banks that have to sell assets they have in order to defend their currencies, in order to get dollars to service debt or transact in oil still. And so all of a sudden, while the S&P is going down, the asset that central banks tend to have is gold. And so gold went down, right? Now,
yeah, because some guys needed to sell them to buy guns, right? Or whatever they needed.
Well, yeah, we joke, but that's probably what, in some fashion happened in, certain countries, right? Like you have to sell assets to raise cash.
Turkey sold 58 tons of gold there last month, right? So,
yeah, I think I read a report that it was like 3 years worth of gold accumulation for them. They had to dump last week, so talk about blowing out your emergency reserve, right? I mean, they had to blow out their emergency reserve reportedly to defend the lira, right? Because oil was spiking in dollar terms, and they got to buy it in dollar. And if the lira is getting smashed relative to dollar, your oil is getting more expensive, both nominally and in currency cross terms, right? So you're getting double whammied, and they had to strengthen the lira in order to keep their economy from blowing up. Well, you got to raise capital somehow to make those moves, and is sell the gold, blow out their emergency reserve. That's kind of what it was for, right? Not much different in theory than the way anyone runs their life, right? You have an unexpected major expense, you got to sell assets and pay for it.
But you don't know going into it, like where that stuff's going to go up, right? You say, well, gold and stocks are diversified, right? So equities get killed. Well, let me look at my gold position. Oh, crap, it's down a lot. Silver, right? Like, so oil, like all those things came up at the same time. And so that's why correlation should be absolutely avoided, because it kind of works when nothing happens. But the whole point of risk management is when stuff does happen. And so that's where I'm like, okay.
Yeah.
No, I shouldn't be that bad, but I think it's a useful concept when you're dealing small stocks portfolio, right? But after that, well, at the end of the day, I'm getting jaded, but there's only one risk factor: it's global liquidity, and when that contracts, because everything is so interrelated, in a globalized world, like you never know which way the stuff's going to come out. Like trying to predict that is.
Yeah, well, it's interesting that you say that. Do you know Michael Howell? Have you read any of his
Michael Howell?
Yeah. Cross Border Capital is his firm. He writes research on global liquidity, but his framework is that global liquidity has turned the corner, is tightening right now. So, you're saying, hey, it's global liquidity. His framework saying, yeah, it's global liquidity. And, what's interesting is like some of the dynamics that tightens global liquidity in his framework would be like a strengthening dollar, an increase in volatility, particularly in the bond market, right? So if you look at the MOVE index as a proxy, it increases. And the reason it tightens liquidity is because the guys that are doing the thing that you talked about at first, which was how much collateral do you have to have pledged against, this portfolio, right? In order to get a loan against it. Well, if the volatility is increasing, they're saying, whoa, that's a lot of risk. There's a lot of value at risk here. So you're triggering our VAR models, and we need you to pledge more collateral, or we can't extend as much of a line to you. Well, if you're taking away somebody's credit, that tightens liquidity. It's just that's the function, right? So to your point, it's all.
That's probably one of the stupidest rules out there as a society is, we let banks run on value at risk models that are still using normal distributions, right?
Mm-hmm.
Because that absolutely, like, banks should be counter-cyclical, right? Like, say, things are good, I'm going to go make some money. Good. Things are bad, let me go see a bank and let me get, some loans to bridge the finances the next year or two, till the crisis has passed, right? It's quite the opposite. People just leverage up when things go up, and then the bank takes away the ability to borrow when things go bad because volatility just increase, right? It's absolutely I don't have a polite way of saying it, so I probably won't, but I feel very strongly like this is the wrong way of doing it.
It's funny. I'll tell you how I adjusted the way I manage portfolios with leverage after we end the call, or end this recording. Yeah, you might find it interesting. Anyways,
but the point is still there's like so many interconnection that we're not privy to. I think it's presumptuous to say, well, I'm going to analyze everything and everything possible there with very crude statistical tools and think that you can. Predict with any degree of precision, what the next thing looks like. So for me, when you manage risk, you just say, there's a point at which I don't know anymore, right? And so I want to make sure I'm hedged, or like that. I can't go above a certain level of losses reasonably. Yeah.
Well, I think the whole conversation today really brings me back to, the old Uncle Warren Buffett quote, right? Which is, the first rule of finance is like, don't lose money. And the second rule is,
don't forget rule number one.
Don't forget rule number one, right? And it's, it was a Charlie Munger, says like, drawdowns are the enemy of compounding, right? Something along those lines. Yeah. The observation being that, like, losing money, it sucks on multiple fronts. We all know that, but intuitively, it all comes back down to just look, like, you have liabilities in your life that come up and are always unforeseen. So it's always nice to have liquidity and access to capital near all-time highs in your account balances. And the second component is, we all know that if you take a 10% loss, you need about 11% to make it back, and that's pretty reasonable and understandable, and it's not really a big concern. And if it is, you probably should rethink investing and, consider, EE savings bonds or something. But if you 50% loss, you need to double your money to make it back, right? And doubling your money takes a long time, right? 11%, pretty quick sometimes. That
could be 2 good days in the market, right?
Two good days in the market instead of 100% though can take you 3-4 good years, right? And so you want to avoid that math, and I think that's the risk that you're really talking about, trying to figure out how to manage and have some kind of solution for it. Because if your answer is, well, correlations historically show us that we should be okay, and we just hold this portfolio long enough, you should make okay money. It's probably not good enough in today's markets.
No, I mean, you should know it, right? Like, but that doesn't mean that it's going to work tomorrow, right? Like, market constantly adjusts to each other, and then when things are broken, small people go in there and then trying to extract profits by fixing it. So yeah, it's not physics. Like, people will think like the engineering way of thinking about market like it's a physics thing. They typically don't last very long, right? Like, it's way more complicated than that. So that's my 2 cents, right? Because you have the chain reaction to the chain reaction. The other thing too is, like, we're talking about benchmarks and things like that. It's like, well, talk about risk adjusted return. Well, that's one thing, but I never seen anybody talk about prudence adjusted returns. Like, there's nothing wrong about being prudent with somebody's livelihood, right?
Yeah.
So, you only have one life, as far as we know. So, don't mess it up. So don't mess it up. Should count always way more than trying to get like 200 bips of quote unquote alpha. But that doesn't mean that you should be overly prudent, right? Like, for me, that's the whole point of risk management. Is like, okay, this is a seriously bad case scenario. Okay, are we covered if this stuff happen?
Well,
okay, now let's try to maximize the money, right? Because I think people will go the other way too. They're way too conservative because they have this fear and they didn't do the analysis and they didn't do the number crunching and the scenarios and all that stuff. And then they're leaving a lot of money on the table, right? And again, that takes a lot of work, right? It's not like something you can do,
well, prudence
a couple hours over
includes
the
taking
weekend.
some risk. But like Ron, prudence includes taking some risk, right? Like it's
100%. Yeah, it goes both ways, right? Yeah,
I always say prudence pays in the long run, right? Like, and it's funny. You say like no one talks about prudence adjusted returns, right? Everyone talks about risk adjusted returns, and the thought that popped into my head was the framework from Howard Marks around like you can never know what the risk was, because even if you realize the risk, you don't know if that's as much risk as it actually had, or you know what I mean? Like what was the risk? How much further could it have gone? You don't know, right? So if you say, well, this investment had a 11 vol over 2 years and did 11%, and this one had 14% return and had a 12 vol, right? Which one do you want more? Which one's more risky? And he would say, like, you have no idea of knowing which one was more risky. If the risks didn't materialize, you have no idea. You can't just say, well, like this one was less risky. You don't know, because the risk didn't materialize and cause an impact, but that doesn't mean that the risks weren't there, right? And so using quantitative math to just say, what's the risk adjusted return, completely, like you're highlighting, dismisses like the prudent adjusted return. I'm going to keep that one.
Yeah, okay.
It's like, that's
sure. But the point is still like, first of all, vol doesn't measure risk, right? Like that's one of the big problems with, you get to assume normality of returns for those things to be correct. And we know they are far from correct, but there's still accounting limits, right? I think this is where risk management again comes into play, right? Like let's say I have like 100 stocks in my portfolio and they're like, all 1% positions. Okay, well, what's the risk of one single position goes to zero? What's my risk? Well, it's 1% of my portfolio, right? Like, so exactly how much risk is in the system. So I kind of disagree with, your job is to put a portfolio together so that you have a really good understanding of the risk that's in there, right? If you don't, if you think you have like, well, things are could this, could that, it's like, then I don't think you have a good, well-constructed portfolio. I'll talk shit with Howard Marks. Let's go.
Well, I think I think he's just saying
because you can put yourself either with options or position sizes. You can absolutely control the risk. You can. So you can't be in a situation where, well, the risk is unfucking known. It's like 100% of it.
Well,
because that's on my portfolio.
So getting into if you get into the framework of using options or defining outcomes, then it is very quantifiable.
Just position. If I have 100 positions, any stock can go to zero. What's the max loss from any position? It's 1%.
Yeah.
Right?
Yeah.
I mean, like maybe we're splitting hair, but I
think we're splitting hairs because I think like my point would be like, okay, but it's still 100% because if all the stocks went to zero, you still, what I mean, like then it's still 100% max loss, right? So
I know, but that won't happen.
But like, it won't, or it's like, near zero, as close to you could get as the absolute zero in physics term, right? Like, but in theory, all I'm saying is more than one stock could go to zero, right?
100%.
And
yes.
and so where is it 6 stocks? Is it 7 stocks? Is it 8 stocks? Is it, how many positions go to zero? We don't know, right? Like,
I know, but can they go to? How many times have you had like a $10 billion market cap go to zero the same day as 10 others?
Yeah, like.
All right, well, 100 billion, whatever. Like that's your job as a manager, right? Is to find those situations where you feel very confident that you have a decent handle on the risk.
Sure.
Sorry, like
no. I agree with you in those terms.
Yeah.
I agree with you in those terms. So, I guess just my point was like in the Howard Marks comment, my point was his just observation is like, look, just looking at, two funds and saying, well, the one that had less risk along the way must have been a less risky fund is not telling the whole story, because you don't know what risks lurked but didn't materialize. And I think that's a fair, analysis, right?
I completely agree.
Yeah.
And then same thing, like, you're not measuring concentration, you're not measuring liquidity.
Yep.
When you're just doing like your Sharpe ratio, right? So it's like, okay, well, you bought NVIDIA, good for you, but that doesn't mean that, what you did was correct, right? Like, so in hindsight it was, but that, we should judge the decision making and the prudence, not the results necessarily, right?
I'd rather make, if I make a good decision and it turns out bad, I'd rather remake that same decision 1,000 times over, right?
Yeah.
Than make a bad decision that turned out good, right? And I think as investors, a lot of times, sometimes we make bad decisions that turned out good, and they influence what we do, and we continue to remake that decision, right? And and if you're making a bad decision that turns out good, and you do it enough times, right? Well, you're the guy in the casino, right? If you are making a good decision that just happened to turn out bad, and you're remaking that decision, you are the casino, right? You are the house.
Right.
And that's the difference between good investors and people that are degenerate gamblers.
We should end on that. This is exactly the lesson of the day. It's like you need to have a process that puts the odds in your favor, and then let it play out over and over and over again. And then as much as you can refine that, that's what you should do, right? Yeah. And then new information is going to get created more markets. You never have like a physics system that doesn't evolve. It always evolves. So you got to bake in, how do I get new info into the system constantly? Because that's very hard to do.
Yeah.
But
well, I appreciate you taking the time to hop on. It's a good conversation.
Yeah, we should do part 2. Like, I think we have a lot more to.
There's a lot more to uncover, but I'm concerned 100%. The only person listening at this point is like the producer.
Right.
I always wonder who makes it this far into the episodes. As a listener, if you're listening, drop a comment. I'd love to hear from you.
Yeah, this guy put me asleep 10 minutes into it, and I went.
Yeah. So, well, hey, I appreciate it. If anyone wants to, find you or your work, Ron, where's the best place for somebody to find you and start, giving you a follow?
That's a good question. Email me at ron@straxon.com. That's probably the best way to get in touch with me. I'm not really a social media guy. Can find me on LinkedIn too.
Yeah. Sure.
Yeah.
All right. Well, yeah. If you're super curious,
we'll contact you, and then
get in touch with me, and I'll get you in touch. So okay. All right. Hey, appreciate it, Ron. We'll see you around.
My pleasure. Thanks for having me. I can't believe it's been 90 minutes already. It really flew by. So thanks for having me.
Absolutely. We'll talk soon.